Hi, I'm James Robinson, and this is a Robinson Stocks stock pick. This is the third video in my 5-part series on the stock Maine Foods. Today we're going to talk about the company's balance sheet. I think most investors don't spend enough time looking at a stock's balance sheet. To me, this is the company's balance sheet has two purposes. The first one is it tells me the company's ability to withstand bad times. It also tells me the efficiency with which the company is managing money. A bad company is going to accumulate debts, and a good company is going to accumulate cash. And the goal is to determine which of those is which, and the best way to do that is by looking at the balance sheet. So it probably goes without saying that the first thing to look at when looking at a company's balance sheet is to look at the cash equivalents, and marketable securities. You can see for this company, it's been pretty stable at about $225 million, which is more than adequate to fund their operations. However, in the last 2 years, it's exploded to about $800 million of cash. There's a number of reasons for that. There's also a number of reasons we're going to talk about later why it's even more amazing that they've got this high. The company's paid some dividends, they bought back some stock, but they've also had a very significant cash expenditure that they've had to make for one of the big customers. And to have done all that while achieving a $500 million increase in net cash is, a really good testament to how well this company is being run. So with this chart, we're looking at current assets and comparing them to current liabilities. Just by way of definition, current asset is any money that you have and expect to have liquid in the next year. Current liabilities are any money that you owe and expect to pay in the next year. So you always like to see that you have enough cash on hand to pay your obligations, and you like to have a buffer on top of that. You can see here that this company is always, over the very long term, never had a situation where they haven't had plenty of money on hand. And over the last few years, that number has expanded dramatically. So this company has plenty of money on hand to pay its short-term debts, and short-term in this term means, a year out. That gives you a nice confidence that the company can do what it needs to do, even investing money in the business, making capital improvements, or better yet, returning money to the shareholders, and still maintain that nice buffer. Another way that we look at the same thing is by what's called a current ratio, and that's the ratio of the amount of current assets related to current liabilities. And you can see here, what I do is I'm comparing our current ratio, the current ratio of this company, Maine, to the average company we've looked at. The red line here represents the top 10% of companies. I've analyzed 1,500 companies, and the red line represents the top 10% of companies. The green line are the top 25% of companies, and so on. You can see in the top in the legend there. And this company has a tremendous amount of money relative to other companies to meet its assets and to meet its liabilities. And again, that tells me this company not only is very, very safe in terms of its short term, it also tells me it has money that we should be thinking about giving back to the shareholders, whether that's through buybacks or dividends, paying down debt, et cetera, et cetera. But when I see this number being this high, it's a really good sign that this operation has plenty of cash on hand to do what it needs to do. Here we're looking at a company's total liabilities, current liabilities, and total long-term debt, and we're comparing them to each other. It's interesting that if you look at a company's current liabilities, they're almost always going to be going up as the company gets bigger, which means as the company gets profitable, they're likely to have higher and higher current liabilities. It's also the case, obviously, that the company likely needs more infrastructure to operate as they grow, and sometimes they'll take on debt to do that. What I like to see is that current liabilities are growing faster than debt. That means that the company is growing, the obligations of the company are growing faster than the debt that they're using to finance those operations. You can see here, generally speaking, I don't like to see companies whose debt is increasing. I like to see companies whose debt is decreasing. I like to see them funding their growth through operations versus through debt. But in this case, you can see the last 4 or 5 years, they have grown their debt. But this is a $4 billion company, and they've grown their debt from basically 100 billion to 150 billion. I'm sorry, 100 million to 150 million. So a 50% increase in debt, $50 million increase in debt on a $4 billion company is, on the verge of 1%, in the area of 1%. It's an irrelevant number. So I don't think that the current liabilities are growing at a rate that's faster or not justifiable by the growth of the earnings. The debt is growing at a rate which is very, very small. So these are very, very good signs. And again, what you're going to see with this Cal-Maine as we go through this analysis, that one of the really strong things I like about this company is the balance sheet. It's one of the things that makes me very interested in the company. So these two slides are important. One of them is looking at the interest expense. I like to have a sense for how much actual money we're spending on interest as time goes on. And you can see this company is spending, in the neighborhood of $1 million or $2 million a year in interest. That's an irrelevancy in a company of this size. More importantly, the next slide looks at interest expense and compares it to interest income. And you can see this company makes about $32 million in interest income. So they've got this $800 million in the bank and it's generating $30 million a year of interest. They also have borrowed a bunch of money and they're paying about $1 million in interest expense on the money they borrowed. So the reality here is that this company's interest expense is a non-issue for the company. Its ability to pay its bills and keep operations going are very, very stable. Another way of looking at the same thing is interest coverage ratio. Interest coverage ratio looks at the ability of the income and cash flows of the business to pay the interest expense. Obviously, one of the things that gets us in big trouble is in bad times, do we have the money to pay the bills, to pay the interest? You can go bankrupt if you can't pay the interest, right? So this company, you can see, has never really had any trouble paying its expenses. They've got, almost 500 times the amount of income that they need to pay their interest expense. So interest expense is a non-issue. And that's one of the real benefits of having companies that, I look really hard for companies that have very little debt or that have significant cash relative to debt, because it makes all of these concerns go away. I don't have to worry about a bad year. I don't have to worry about the market taking a downturn. My company's going to survive. They're going to do fine. They may not make as much money in a bad time, but I have no concerns about the company going bankrupt. And that allows you to sleep well as an investor. Along the same lines, again, all of these slides look like this is a non-issue because this company is so solid. But 80% of the companies I look at don't have this slide, right? They look very, very different. So here what we're looking at is the number of years of income it would take to pay off our debt. And you can see that in this company, it's much less than 1 year's income to pay off the debt. And I like that. That means we're not making decisions we wouldn't otherwise make because of debt. It also means that if we have an opportunity to intelligently use money, we've got financial reserves in the form of banks desperately wanting to loan us money. But again, I would encourage you to consider that while most of the stocks that I show you are very, very low in terms of years income to pay off debt, the average company is at or above that green line in terms of its abilities. And it's hard to get a sense for how exceptional our companies are, the companies that I choose are on this basis, because every company that I show you is sort of always marching to these same patterns. But generally speaking, you'll see these numbers being a lot higher. So yet another reason why I think Cal-Maine stocks as a company you should consider. So real briefly, this slide looks at the company's interest expense and compares it to the operating income. And you can see that, again, when you're only paying a couple $1 million in interest expense in your $4 billion company, you're going to be way, way below that goal of mine, which is 15%. We're, on the verge of 1 or 2%, maybe slightly below that here. It's almost like you should just take the balance sheet, and I could say to you, the balance sheet for this company is rock solid. It's absolutely brilliant, and we shouldn't think about it. But you do have to recognize that I've considered this, I've looked at this, and I look at chart after chart, and I analyze all these things. And while I'm showing you how great these are, again, most companies that we look at don't meet these criteria. Debt to equity ratio, again, is the company has way more equity than debt. It really doesn't show up as an issue for this company. It is interesting to note that in 2005, it was, not in the top 25% of companies. And in the last 20 years, it's gone to the point where the debt relative to equity is irrelevancy. That's a long-term trend that shows how well this company is. That's it for the balance sheet of this company, and it's pretty easy to summarize. You've got virtually no debt. You have $700 million in cash. Your current assets significantly outstrip your current expenses. Your income is far more than you need to pay your debts. This is a company that has a bulletproof balance sheet. It's absolutely strong. And one of the other things that we should talk about with this balance sheet being so strong is it's the kind of thing that attracts investors. This is a relatively small company, $4 billion, and it's trading at 7 times earnings. And it's got this fantastic balance sheet, including $700 million in cash, 28,000 acres of land, all free and clear, 50 million chickens that are have a value of almost $1 billion, on and on and on. And when you look at that balance sheet, and then you look at the fact that this is an industry that every year people are going to keep eating eggs, you wonder how long is it going to be before somebody comes in. By the way, they're the largest producer in the industry. And you wonder how long is it going to be before a Tyson's Foods or a Procter & Gamble or somebody decides they want to get in the chicken business. And wouldn't it be easier just to buy these guys than to start their own, especially at these prices? So I think we have the upside with this business of it can continue to do well and throw off cash flow. We can make our money because it disperses some of that $700 million to us, the shareholders. It's also the case that this company might just get bought by somebody who likes the rock solid balance sheet and likes the rock solid industry. So that's it on the balance sheet for this company. Thank you for your time.